the Union Budget brought about several amendments in the direct tax laws. The key one being the rationalization of capital gains tax regime. The amendment proposed are in the holding period of the assets as well as the tax rates. What has been sought to achieve is the rationalization and alignment of the tax rates, which is for long term, the rate has been aligned to 12.5%, while for short term capital asset it is aligned to 20% so far as listed stocks are concerned. So far as the unlisted assets are concerned, like shares or any property, the normal rate of tax would continue to apply. Similarly, the holding period has been rationalized to either 12 months for long term capital asset or 24 months for short term capital asset. So, this has really brought about a simplification and rationalization of the capital gains tax regime. The second important amendment which is made is under buyback tax or buyback provisions, where the buyback of shares would now be considered to be dividend income in the hands of the recipient, and the company which is doing buyback will not be taxed. This would result into higher tax incidence in the hands of the shareholders as against 20% tax which was being paid by the company. The shareholder will also be able to claim the capital loss because the shares are extinguished in his hands. So, and the capital loss could be set off against the capital gains income which is earned by the shareholder. This could result into higher tax incidence as the intention is to bring buyback at par with the dividends payout by the companies. And the third and the important amendment is in the angel tax provisions. Section 56 has been amended and to provide a sunset clause to say that the section 56 to 7b will not apply going forward basis for any share capital infusion along with premium in the companies. Earlier the tax authorities used to question the higher valuation and the share premium being infused, and the justification was asked, and that led to a lot of litigation with the tax authorities, where the companies were unable to justify the valuations of the higher premium which is being infused. The provision is now sought to be abolished from the current year onwards. This would substantially lead to clarity in terms of the commercial agreement of the share valuations and premium between the investor and the companies, and will substantially lead to reduced tax scrutiny and litigation with the tax authorities. Thank you.